Welcome to today's video on the business economy front. And today we're going to be looking at the Bank of England and their new policy guidelines that they're looking into at the moment. And one of the chief economists of the Bank of England has just this past week stated that the Bank of England may very well need to push its interest rates into negative territory in order to be able to fight off the next recession. Now let's just unpack that just for a moment. And what does a negative interest rate effectively mean? It means that should you borrow £100 from the Bank of England with a negative interest rate of 1%, you borrow £100, you only have to pay them back £99 in a year's time, interest included. So in other words, the longer you hold on to the borrowed money, the less you have to pay back. So if you think about it in terms of, say for instance, your mortgage, that if you have your mortgage at negative interest, it means that you borrow the money to buy your house and you land up paying the bank back less money than what you actually borrowed in the first place. Which, from the point of view of trying to stimulate the economy, on the face of it, sounds like it could be a good thing, but then again, how are banks going to be able to generate their own income with interest rates in negative territory? But then there's another far more serious factor that will be affecting commercial banks should interest rates dip down into negative territory. If you have savings in the bank, why the hell would you keep your savings in the bank if the longer your savings stay in the bank, the lower the amount of money that you have? Because the same effect that the Bank of England states as far as negative interest rates for borrowings would be concerned would be the same negative interest rates as far as savings are concerned. So you put your money you put your £100 into the bank, and at the end of the year, you've got 99 or 98 pounds left. That's excluding what the bank will be taking by way of service fees and commissions, but just simply the interest rate, the interest that you'll be earning in your bank account will actually be taking money away from you. And the simple solution as far as that's concerned is if the interest rates become negative, it will be far more worth everybody's while to draw their money out of the bank and keep it in cash, because holding your money in cash, it's not losing any of its face value. Put your money into the bank with negative interest and it loses face value on a daily basis. So one of the solutions that the policymakers would be needing to look at is that as I said, with people drawing their savings out of the bank and holding it in cash, that this will actually be slowing the economy rather than boosting the economy. And the only way to be able to physically get around that problem, according to this economist from the Bank of England, would be to abolish cash. In other words, make cash notes of zero par value. In other words, if you're holding on to cash, your cash suddenly becomes worthless pieces of paper. And the same economist has said that if you look at digital currencies such as Bitcoin has no cash equivalent. It's only a currency within the realms of the internet. So from that point of view, what he's looking at is doing away with cash altogether and maintaining a interest rate in negative territory, which means that if cash has been done away with, then people will be forced to keep their savings in the bank and be forced to be losing money by keeping their savings in the bank. One of the things to be having a look at that is that by looking at the who would be the most vulnerable to this type of a policy change? And the people most vulnerable to this type of policy change would be the poor as well as the elderly, because the elderly will be the ones that will be keeping their savings in the bank, and the elderly will not be borrowing as much money as the young people and business people will be. So it will be the elderly that will be losing out, and it will be the poor that work mainly and effectively in cash that will be losing out if cash is given a zero par value. And this economy from the Bank of England has suggested that there's little evidence to suggest that these welfare costs, as he puts them, would be incredibly large. So in other words, the negative effect to the elderly and the negative effect to the poor people would be way easily offset by the benefits to the Bank of England, the benefits to the British economy and effectively the British government, and the benefits to the British wealthy who are borrowing more money, and it's these British wealthy that are effectively holding up the economy. So that's the rationale behind this new potential policy change. We'll have to see how this plays out over the course of the next couple of weeks, and you can be rest assured that I'll be keeping my eye closely peeled on this one and bringing you updates as they unfold. That's it for today, and keep tuned in to the BizCoach Edu channel for more and new business-related, investment-related updates as they happen. Stay tuned for all my upcoming videos, and please remember, click the like button, share this out amongst your friends, and also down at the bottom of the screen there is a red subscribe button. Hit that red subscribe button, subscribe to my channel, that way you can stay up to date on all of the new business and investment relating issues as they happen on a day-to-day, week-to-week basis. Stay safe out there. I'll see you next time. Cheers.